Good morning, students. Welcome you back once again on Ind AS 36 impairment of assets, which is for financial reporting CA final curriculum. So, students, so far we have understood, so far we have gone through with so many asset-based standard, right? And when I talk about impairment of asset, so of course this is a P&L related standard, but this standard is related to assets because we are talking about impairment of assets, right? So when I talk about the word impairment, what comes in your mind? Is it something positive? Is it something negative? Is it something appreciation in value or is it something depreciation in value? What comes to your mind? So talking about impairment, of course, impairment is a negative word. When I say negative word, impairment means reduction in value, right? So when the value of the asset goes on decreasing, when the value of assets are decreasing, it means there is an impairment. It means there is an impairment, right? So impairment is reduction in the value of the asset. Now the question comes, how impairment is different from assets? How impairment is different from depreciation, right? So if I talk about different asset related standard, for example, Ind AS 16, for example, Ind AS 38, in Ind AS 16, we have discussed the definition of carrying amount. In Ind AS 38, we have discussed the definition of carrying amount. And in Ind AS 40, you have also discussed or you have also learned the definition of carrying value, right? And what is the definition of carrying value? The definition of carrying value is cost minus accumulated depreciation minus accumulated impairment losses, right? Cost minus accumulated depreciation minus accumulated impairment losses. So we are talking about, for arriving at a carrying value, we are talking about depreciation, we are talking about impairment losses. Now what is difference between depreciation and impairment? If I ask you what is the difference between depreciation and impairment, and when I am talking about depreciation, it includes amortization as well, right? Because when the tangible assets are decreasing, it is known as a depreciation. When intangible assets are decreasing, it is known as an amortization. Okay, so the objective is same, the only thing is the name is different. For tangible we are using word depreciation, for intangible we are using word amortization. So guys, how impairment is different from depreciation? If I talk about depreciation and impairment, impairment is something which is over and above of depreciation, right? Impairment is extra dent to the P&L, extra damage to the P&L, extra hit to the P&L, right? So if I distinguish between depreciation and impairment, because at times students get confused that why impairment is not a depreciation. So if I talk about difference between depreciation and impairment, I can tell you that depreciation is kind of a regular impact. It is kind of a regular impact. But impairment is extra hit in the P&L, extra hit in the P&L. Okay. Or I can say that it is over and above depreciation, over and above depreciation. For example, you have purchased a car, right? Srinidhi has purchased a car, and that car is a diesel car. And for example, she has purchased this car in the state of Haryana, in Gurgaon. Okay, so the cost of the car was 10 lakh rupees, and the useful life is 10 years. I'm assuming scrap value is zero, right? So 10 years life, 10 lakh rupees of cost. What is the yearly depreciation? What is the per annum depreciation, Srinidhi? Per annum depreciation is 10 lakh divided by 10 years, 1 lakh rupees every year. What is the carrying value at the end of the first year? 9 lakh rupees. What is the carrying value at the end of the second year? 8 lakh rupees, right? But at the end of the second year, the carrying value was 8 lakh rupees. And when we are charging depreciation on a straight line method, we are assuming that the consumption of the asset is also on a straight line basis, right? It means we are getting the future economic benefit evenly throughout the life of the asset, right? So this is the objective, this is the purpose, this is how we are charging depreciation, right? Now, at the end of second year, the government has come up with an announcement that diesel car will be banned in Gurgaon. Okay, diesel car will ban in Gurgaon, let's say after 6 months or 1 year down the line. Now tell me, due to this announcement, do you think that the market value of the car will substantially go down? Do you think this, that the market value of the car will substantially go down? Yes, Srinidhi, Ayush, Ruchi, Megha, what is your view? Yes, the market value of the car will substantially go down, because this is a negative kind of announcement. And when government is saying that the diesel car will ban in Gurgaon or Haryana in 6 months down the line, 1 year down the line, it means whenever you are purchasing an asset, you are purchasing from a future perspective as well, right? So market value will of course go down, because if you will sell this asset in Gurgaon, so of course this car will not be sellable in Gurgaon, or this car will not be sellable in Haryana. The dealer has to sell this car in some other state, okay, which includes your transportation cost, which includes your duties as well, right? So friends, every year we were charging depreciation of rupees 1 lakh. But when this announcement came, you all agree that the market value of the car will go down. And for example, instead of 8 lakh, this market value becomes 6 lakh rupees, right? So in the second year, my carrying value was 9 lakh rupees. My carrying value was 9 lakh rupees, right? So 9 lakh rupees was my carrying value. Just a minute. 1 lakh rupees was depreciation, 8 lakh rupees was carrying value, but the market value becomes 6 lakh. So what is this 2 lakh? This 2 lakh is impairment loss. This 2 lakh is impairment loss, right? This 2 lakh is my impairment loss. This is over and above of depreciation. Just think about this. Depreciation is a systematic consumption. Depreciation is a systematic charge. Okay, systematic charge means every year 1 lakh rupees. It is a systematic charge. But when I talk about impairment, it is one-off. It is not systematic charge. You are not able to identify that yes, in this year 2 lakh impairment is there, and in the next year 2 lakh impairment will still be there. So this cannot be predictable, right? But depreciation is a systematic charge, right? Depreciation is a consumption based. Depreciation is a consumption based item, right? So depreciation is a consumption based, okay? But impairment is event based. If this negative announcement would not have come, then the impairment would not be there. Agree? If this negative announcement would not have come, then this impairment would not have been there, okay? So this is a regular charge. This is an extra hit in the P&L. Depreciation is a systematic charge, but impairment is a one-off event. Impairment is one-off event. Just give me some time. I don't know what is the problem with this pen. Yeah, it is working now. So depreciation is a consumption based, and impairment is event based. Okay, impairment is event based. In my example of car, due to this government announcement, the market value of the car has gone down. But do you think that the performance of the car will go down after this announcement? Answer is no. The performance of the car will not go down. The car is the same car which you have parked before announcement. The car will still give the same level of performance. This car will run very smooth. This car will provide the same performance if you will run in other state as well. In other state, there is no any problem, right? So there is no decline in the performance of the car. There is no decline in the features of the car, but the value of the car has gone down. So it is not a consumption based. Impairment is a event based, right? Impairment is a event based. Okay. So now you must have understood the difference between depreciation and impairment, right? Let me know if you have any problem so far. I hope you have understood the difference between the depreciation and impairment. Yeah. So depreciation comes first, then impairment comes, right? So if I talk about the sequence, of course, depreciation will come first, then impairment will come. Okay, so it will come later. Clear? Yeah, good. So friends, impairment is something which is event based, which is indicator based, which is indication based. And please remember this car example in your mind. Okay, so the depreciation is 1 lakh rupees every year, but the impairment is due to this negative announcement, right? And just 2 3 years back in Delhi, there was an announcement that diesel car will run only for 10 years. So I have a diesel car. On the registration certificate, the life is 15 years. But in Delhi, you cannot operate the diesel vehicle beyond 10 years, right? So my market value of my car has gone substantially down, right? Why? Because there is a restriction of the limited usage, and this limited usage is less than what it was earlier, right? So, but if I talk about the performance of my car, the features, the performance, everything is same. Due to this announcement, there is no impact on the performance. But of course, there is an impact on the life. There is an impact on the usage where I am operating, right? Is it clear? Great. So coming to the agenda of this standard, friends, we'll talk about the objective because every standard starts with an objective, right? Every standard starts with a scope, that what is included in the standard, what is not included in the standard. And of course, we'll talk about the meaning of impairment loss, that what is meant by impairment loss, right? So we'll talk about this. Identification of an asset that may be impaired. So friends, although this standard is a kind of theoretical standard, but the standard is very important standard, right? So we'll do a lot of practical aspect as well, and I'll take a lot of practical example, layman language example, so that you will be able to understand the importance as well as the concept of this standard, right? After COVID, this standard has gained a massive weightage, right? So prior to COVID, if I leave the big listed companies, the other companies were not using this standard, honestly speaking. But after COVID, every auditor and every management is more concerned about the impairment. Okay, if I talk about my business, so when you are running your business, if the business is running smooth, okay, so you can say that I'm able to earn profits, I'm able to make money, my assets are worthy assets, my assets are able to derive future economic benefit, my assets are able to generate future economic benefit, okay, in the same manner in which I am expecting. Okay, so whatever is the value which is lying in the balance sheet, these assets are well capable of getting these values, right? But after COVID, there are a lot of companies where where the future economic benefit comes into as a question, or where I can say that there is a massive impact on the business of those companies. For example, let's say hotel industries. For example, hotel, if I talk about Oyo is into hotels. So when there was a COVID, when there was a lockdown, of course nobody will able to use, or nobody will wants to go to the hotel, right? So restaurant industry, hotel industry, these kind of industry has severely impacted. Cinema theater like PVR cinemas, right? Multiplexes, malls. So in these kind of industry which is into events, which is into malls, which is into restaurant, which is into hotels, so these kind of industries are badly impacted, because if there is a COVID, of course major footfall will not be there. If there is a lockdown, nobody will use these kind of places, or these kind of benefits, right? Or these services. So it means due to this COVID situation, COVID was a great indicator of impairment. I'm not saying that if there is a COVID, the asset should be impaired, but it is an indicator of impairment, right? Why? Because due to COVID, there are some companies, there are some industry which is not able to operate, or which is not able to make money. If I talk about telecom, if I talk about medical industry, of course, there is no impact of COVID. There is no major impact of COVID in these kind of industries, right? Telecom, due to COVID, these classes are going virtual. So how these classes are going virtual? You guys are using internet for watching these classes. I am using internet for delivering these classes. It means the usage of the internet has gone manifold, right? And from where this internet comes, this internet comes from telecom companies, right? So the demand of data, the demand, the calling data demand, this demand has increased, and hence this COVID has a very positive impact on the telecom industries. This COVID has a very positive impact on the medical industries. For example, Dr. Lal Pathlev, okay, so everyone is moving towards sample testing, blood testing, right? If I talk about hospital like Medanta, if I talk about Max hospital chain, if I talk about Fortis group, so of course you have seen that in COVID situation there was no bed available, right? So COVID is a positive impact on these kind of industries, but COVID is a negative impact on some kind of industries. So we need to see, if my business is not able to generate future economic benefit, of course we need to do the impairment testing. And let me tell you friends, impairment testing is not a simple exercise, okay? Impairment testing is a cost compulsive as well as time consuming exercise. You need to do a lot of calculation, you need to do a lot of valuation, okay? You need to do a lot of projections, okay? So that is why this standard gives you a guidance that you need to identify an asset which may be impaired. The word is not which shall be impaired. The word used is which may be impaired. What does it mean? It means it can be impaired, it cannot be impaired. It means impairment may be there, impairment may not be there. Okay. So identification of an asset that may be impaired. Okay. So this standard gives you a guidance that, my dear friends, you are not required to go for the calculation of impairment for every asset, but you need to identify which asset may be impaired, right? Right. Sairam is saying, sir, impairment is charging every or any of year when event is happened. You're right, Sairam. The third, of course, we'll talk about recoverable amount. And I know that this word recoverable amount is not new for you guys. You guys are CA final student, and in accounting standard 28, we have discussed, we have learned about recoverable amount. What is recoverable amount? Recoverable amount is nothing. Recoverable amount is higher of fair value less cost to sell and value in use, right? So recoverable amount is higher of fair value less cost to sell and value in use. Okay. So this standard talks about what is the objective of this standard. The objective of this standard is, in your balance sheet, no assets. This standard only talk about assets. The title is impairment of assets. There is no impairment of liabilities. Impairment of liability is a very positive word, right? If liability is decreasing, it means organization is growing, right? So guys, when I talk about impairment, it is only on asset. So the objective is, in your asset line items, no asset should be stated at more than the recoverable value. For example, the carrying value is 100 rupees, but the recoverable value is 80 rupees. It means you need to charge an impairment loss for 20 rupees. Okay. Doesn't matter whether you're opting for cost model or revaluation model, but if there is an impairment, you need to charge it into the PN, right? So basically, the idea and objective is, in your balance sheet, your assets should be stated at a value which is no more than the recoverable value. If it is less than recoverable value, it is okay, but it should not be recorded at more than the recoverable value. Okay. So you need to measure the recoverable amount. And what is recoverable amount? Recoverable amount is higher of fair value less cost to sell and value in use. Okay. So we'll talk about this. Then we will discuss how to recognize and measure impairment loss. How to recognize an impairment loss, how to measure an impairment loss. Okay. Whether impairment loss has to be recognized in P&L, whether impairment loss has to recognize somewhere else, and how to measure an impairment loss. We'll talk about this aspect as well. Then we will talk about the cash generating unit. So guys, as far as the standard is concerned, this standard is applicable on impairment of individual asset and impairment of group of asset, right? So individual asset and group of asset. For the time being, I'll call group of asset as a cash generating unit. Okay. So this standard says that this standard also gives guidance on cash generating unit. What is my CGU on cash generating unit, and goodwill and corporate assets, right? So this standard talks about goodwill as well as corporate assets, right? So this standard talks about how to allocate goodwill. What will be the impact of goodwill in case there is an impairment of assets, right? This standard also talks about the concept of corporate assets. What is the concept of corporate asset? Just give you a highlight of this. Corporate office is like an office building. So corporate assets are those assets which is not directly related to generation of revenue, but which is related to support, which is kind of a support function for a business. If this office, what is office headquarters? So the factory building is directly related to the manufacturing, right? Directly related to generation of revenue. But if I talk about office building, so office building is more towards a administrative activity or administrative task, right? Allocation and reversal of impairment loss. This standard also provides guidance how to allocate an impairment loss in case of a group of assets. If there is an impairment in the group of assets, how to allocate this impairment in the group of assets, and when an impairment loss can be reversed, right? And of course, last but not the least, disclosures are there. We'll not talk about disclosure, but yes, I have carried disclosure in my PowerPoint presentation. So guys, agenda is clear. We'll talk about what is impairment loss. We'll talk about identification of an asset which may be impaired. We'll talk about how to measure a recoverable amount. Then we will discuss how to recognize and measure impairment loss. First, we need to calculate recoverable value and the difference between the recoverable value and carrying value. If the carrying value is higher than the recoverable value, then the difference comes out as an impairment loss, right? Then we will discuss the concept of group of asset, which is cash generating unit. We'll discuss the concept of goodwill here, and we will discuss the concept of corporate assets as well, that how to recognize impairment loss in case of corporate assets are there, right? Then we'll talk about the allocation of impairment loss into the group of assets and reversal of impairment loss when impairment loss can be reversed, okay? And disclosures. I hope the context is set. I hope everyone is clear about the agenda. Let me know if you have any concern, any doubt, any issue so far. Jay, Sairam, Srinidhi, yeah, Megha, Ayush, Pulkit. Yeah, good guys. Great. Let's move on. Coming to the objective of the standard, we are well clear about the objective. The title is impairment of assets. And what is the objective? This standard ensure that the assets are carried at no more than their recoverable value. Okay. The assets are carried at no more than their recoverable value. Okay. So recoverable value is higher of fair value less cost to sell and value in use. It is higher of fair value less cost to sell and value in use. Okay. Determination of recoverable amount. This standard also provides that how to determine the recoverable amount. So what is my recoverable amount? This standard gives a guidance that what is recoverable amount, how to calculate recoverable amount. So we'll talk about this. Allocation and reversal of impairment loss. So this standard talks about the allocation and reversal of impairment loss as well, that how to allocate impairment loss. When I talk about allocation, it is not on the individual asset, it is on the group of assets, right? It is on the group of assets. This standard talks about the disclosures as well. Okay. So first, every asset should be stated at no more than no more than their recoverable value. Then what is a recoverable value? The standard provides guidance, and the standard provides guidance on the allocation and reversal of impairment losses, right? Coming to the scope part, this standard applies to all assets, right? When I talk about impairment, this standard is applicable to all impairment except, so there is a negative list which is given, except, and what is the negative list? So this standard applies to all assets except inventories. So guys, in inventory there is also impairment. Okay. When you see inventory, so inventory is stated at cost or market value, whichever is lower, right? Cost or market value, whichever is lower, right? So if the cost is 100 rupees and NRV, not market value, net realizable value. If the cost is 100 rupees and NRV is 80 rupees, then there is an impairment. But that impairment is taken care by Ind AS 2 inventories. That impairment is not comes within the purview of Ind AS 36, right? So Ind AS 36 concept is comparing the carrying value and the recoverable value, right? And the concept of recoverable value is something different than the net realizable value, right? So concept of recoverable value is higher of fair value less cost to sale and value in use. Higher of fair value less cost to sale and value in use. Okay. So guys, on inventories impairment, Ind AS 36 is not applicable. On inventories impairment, Ind AS 2 is applicable. In Ind AS 115, revenue from contract with customers. So of course there is a contract assets and assets arising from cost to obtain or fulfill a contract. So there is a contract asset. If there is a contract asset, of course, on these contract asset, if there is an impairment, so Ind AS 115 will be applicable. Ind AS 36 is not applicable on contract assets, right? So on Ind AS 2, inventories Ind AS is not applicable. On contract asset, Ind AS 36 is not applicable. Deferred tax assets. So for example, you have created a deferred tax assets, right? Why? Because there is a probability of recovery of taxes in future. But tomorrow you are having a losses and you don't have any probability of recovery of taxes in future. So of course you have to impair this deferred tax asset, but the impairment of deferred tax asset has to be as per Ind AS 12, not as per Ind AS 36. Assets arising from employee benefits. For example, there are plan assets, right? So for gratuity, you have created a plan assets. And since market is declining, this plan assets has also declined. The value of the plan asset has been declined. So the decline in the plan asset has to be taken care as per Ind AS 19, not as per Ind AS 36. Okay. Biological asset measured at fair value less cost to sell. So guys, in Ind AS 41, we have read that biological asset has to be measured at fair value less cost to sell. And when I talk about biological asset has to be measured at fair value less cost to sell, and if you are measuring anything at fair value, it is already taking care of your impairment aspect as well. It means, for example, the market value is 10 rupees or 100 rupees. So if the market value is 100 rupees, it means it is after impairment. Okay. So it is the actual value as on date. So if something which is calculated on fair value, it means it is already taking care of impairment piece as well. So this Ind AS 36 impairment, this impairment concept is not applicable on Ind AS 41. Okay. If impairment is there, for example, there is a biological asset which has been recorded at 1000 rupees, subsequently it become 800 rupees, there is a decline in fair value, there is an impairment, but that impairment is as per Ind AS 41, not as per Ind AS 36. So there is a standard Ind AS 104 in insurance contract. So on insurance related assets, Ind AS 104 is applicable, Ind AS 36 is not applicable. Non-current assets classified as held for sale. If there are non-current asset, for example, building, if the building is classified as held for sale, it has to be measured at carrying value or fair value less cost to sell, whichever is lower. So when it is getting measured at carrying value or fair value less cost to sell, whichever is lower, of course there will be an impairment, but on that kind of impairment, Ind AS 105 is applicable, Ind AS 36 is not applicable, right? On financial assets, Ind AS 109 is applicable, for example, investment, for example, mutual funds. Okay. So if the value is declining, of course there is an impairment, but the concept of Ind AS 109 will be applicable. Ind AS 36 guidance is not applicable. So on impairment aspect, Ind AS 36 is not applicable on financial assets, but this standard is applicable on investment in subsidiary, investment in joint venture, and investment in associate, right? I hope it is clear to everyone so far. Yeah. Thank you, Srinidhi, for the feedback. Thank you so much. Yeah, good. Now, what is an impairment loss? What is an impairment loss and when there is an impairment loss? So I have a mobile phone, and this is OnePlus 5G phone. The cost of this phone was 55,000 rupees when I have purchased this phone. right? So I have recorded this mobile phone in my balance sheet at 55,000 rupees. For example, I'm assuming a life of 3 years. So what is my yearly depreciation? What is my annual depreciation if the life is 3 years? Roughly 18,000 rupees per year. So at the end of the first year, 55,000 minus 18,000, 37,000 is there. At the end of the first year, the value of my phone is 37,000 rupees. But do you think that after 1 year, the value of this phone will be 37,000 rupees? There could be 2-3 new models. There could be 2-3 new phone in the market, and at a lesser price you will be getting more features. So of course the value of the phone will not be 37,000 after 1 year. Okay, so it could be, for example, 25,000, it could be 30,000, right? So I am showing my asset at 37,000 rupees after 1 year, at the end of 1 year in my balance sheet. But the actual market value of this phone, mobile phone, is, let's say, 30,000 rupees. It means today I'm showing my asset at higher than the recoverable value. If I'll go into the liquidation today, my asset will not fetch more than 30,000 rupees. It means there is an impairment. It means there is an impairment, right? So impairment is there. Okay. So I need to recognize the impairment loss of 7,000 rupees, and I have to reduce the value of this asset by 7,000 rupees to get this at recoverable value, Okay. Okay, friends, is it clear to everyone? So impairment loss is the amount by which the carrying amount of an asset or cash generating unit exceeds its recoverable value. So in this case, if I talk about the difference between 37,000 and 30,000, so what is this? 37,000 and 30,000. So this is my carrying value. My carrying amount was 37,000. My recoverable value, market value, was 30,000. So of course my carrying amount is greater than my recoverable amount, my market value. So it means there is an impairment loss of 7,000 rupees, right? The impairment loss is for 7,000 rupees. So when the carrying value becomes higher than the recoverable value, of course there is an impairment loss, right? So in that case, carrying amount minus recoverable amount is equal to impairment loss. And what is the recoverable amount? Recoverable amount is higher of fair value less cost to sell and value in use. I'll discuss these two aspects later on. The recoverable amount of an asset or a cash generating unit. So guys, please remember, whenever we are reading this standard, whenever we are learning this standard, we are talking about two aspects. One, we are talking about impairment of an asset, and we are also talking about impairment of a group of assets. Impairment of an asset and impairment of a group of assets. Clear? Clear? For the time being, this group of asset is nothing, it's a cash generating unit. The recoverable amount of an asset or a CGU, cash generating unit, is the higher of fair value less cost to sell and value in use. Okay, so you need to compute your fair value less cost to sell and the value in use, and whatever is higher, it becomes your recoverable value, right? Clear? Is it clear, friends? For example, I have a car. For example, I have a car. Okay. The fair value less cost to sell, the fair value less cost to sell of my car is 10 lakh rupees. Okay. So we are calculating the recoverable amount from the disposal concept. It means if I want to sell this car, what is the fair value of this car? And of course, if you will sell something, then of course there may be some cost to sell as well, right? So that is why we are reducing cost to sell. For example, if I'm selling my building, I will have to pay some duties, I will have to pay some commission, I will have to pay some directly incremental cost, right? So net, if I talk about what will come into my hands, if this building is getting sold at 20 lakh rupees and 1 lakh rupees is the cost to sell, so in my hand net 19 lakh will be there, right? So guys, in this example, for example, the fair value less cost to sale of the car is 10 lakh rupees. And value in use, what is meant by value in use? If I will not sell this car, I will use this car to the lifetime of this asset, right? So what is the value I will get by using this asset? Fair value is a market specific value. Value in use is an entity specific value. Fair value is something which can be derived by selling the asset. Value in use is something which can be derived by using the asset. If I will use this asset for the next 10 years, what is the future economic benefit? What is the cash flow we will receive by using this asset? And what is the present value of those future cash flows? This is known as a value in use. This is known as a value in use. Okay. So for example, the value in use is 8 lakh rupees. So what is my recoverable amount? What is my recoverable amount? My recoverable amount is higher of these two numbers, which is my 10 lakh rupees. My recoverable amount is 10 lakh rupees. Okay. It is 10 lakh rupees. Clear? So this is higher of what we will receive by selling that asset into the market, which is nothing. It's a fair value less cost of disposal. Second, what we will receive by using the asset till the lifetime of the asset. This is known as a value in use. As the name suggests, fair value less cost to sell. It means you are going to sell some asset and then you will receive the fair value. Okay. The name value in use, it means what is the value in use? What is the value you are deriving after using this asset, while using this asset? Clear? Yeah. So guys, let's quickly do this example or case study. The carrying value of a building in the books of ABC Limited as at 31st March 2016 is 250 lakhs. As on that date, the value in use is 200 lakhs and the fair value less cost of disposal is 188 lakhs. Calculate the impairment loss in the books of ABC Limited. What is the carrying value, friends? Friends, what is the carrying value? The carrying value is equal to 250 lakhs. And now we need to calculate the recoverable value. What is my recoverable amount? What is my recoverable value? For calculating the recoverable value, you have to calculate, first of all, fair value less cost to sell, and it is given at 188 lakhs. And you need to calculate value in use. It is given at 200 lakhs, right? And when I say higher of these two, what is my recoverable amount? My recoverable amount is higher of fair value less cost to sell and value in use. So what is the higher number? What is the larger number, 200 or 188? 200 is a larger number, 200 lakhs. So my recoverable amount is 200 lakhs. My carrying value is 250 lakhs. Is there any impairment? Yes. My carrying value is higher than the recoverable value. So I have stated my asset, I have shown my asset in the balance sheet at higher value than the recoverable amount. So what is the impairment loss? Impairment loss is equal to carrying value minus recoverable value. So it is 250 minus 200. 250 minus 200. It is 50 lakhs. Okay. So impairment loss is 50 lakhs. Is it clear? Sairam, I will explain what value in use. Don't worry. So I'll explain again what is fair value less cost to sell, what is value in use. I'll do that. But for the time being, just remember that the recoverable value is higher of fair value less cost to sell and value in use. Yeah. Okay. So this 50 lakh is the impairment loss. Clear? Let's come to the next part. So far we have understood the impairment loss, we have understood the recoverable value. Now the next part and very important part, identification of an asset that may be impaired. Identification of an asset that may be impaired, right? So an entity is required to assess at the end of each reporting period. And I have told you, friends, this is not a plain vanilla exercise. As an auditor, you can go to a company and you can say, as an auditor, you can go to a company for audit and you will say, you need to do the impairment testing of all these assets, right? So probably the CFO or the management will not agree with your views, right? The management and auditor will say, my company is a very good company and we are earning crores and crores, right? we are having a lot of future economic benefit, we are generating profit, we are a profit making company, we don't have any losses, we don't have any borrowings, right? We are a cash rich company, we are a profit rich company. Then why you are saying, why you are asking for an impairment testing, right? I'll not spend any penny on impairment testing, right? Because impairment testing is not a paper exercise, impairment testing is a valuation exercise, right? And management will not agree with this. Why management will not agree with this? Management will not agree with this because in Ind AS 36 there is a guidance which is given, and it says that you need to identify that which asset may be impaired, and at the end of each reporting period management should identify. Okay, and how management should identify? First of all, management should identify whether there is any indication that an asset may be impaired. So management should identify the indication of an asset that may be impaired, that may be impaired. Okay, so guys, first of all, at the end of each reporting period management should check for the indicator of impairment, right? And if the indicator exists, then only management should estimate the recoverable amount. Then only management should estimate the recoverable amount. Okay, so I'm sharing my Excel file, and let me know if this Excel file is visible, friends. Right, so we have talked about the objective, we have talked about the scope part. Now we are talking about identification of an asset that may be impaired, right? That may be identification of an asset that may be impaired. So standard says that at the end of each reporting period, at the end of each reporting period, for example year end, each reporting period, management should check, management should check if there is an indicator of impairment, an indicator of impairment. Okay, management should check if there is an indicator of impairment, and if the answer is yes, and if there are indicators exist, then estimate recoverable amount, then estimate, do the impairment testing, and estimate recoverable amount. Okay, so guys, first of all, you are not required to do this impairment exercise bluntly. You need to see whether there is any indicator exist which says that this asset may be impaired, and if the indicator exists, then only you can go for the impairment testing. Otherwise you are not required to go for the impairment testing, and you are not required to estimate the recoverable amount. For example, in case of a COVID was an indicator of impairment for luxury companies, for this travel companies, for this hotel companies, okay, for this restaurant companies, event management companies, right? So for these companies, this COVID was an indicator of impairment, and hence the management has to do an exercise that what is my estimated recoverable amount, what is my recoverable value. And if the recoverable value is lower than the carrying value, then there is no problem. But if the recoverable value is higher than the carrying value, then the impairment was required to be charged in the profit and loss account, right? Is it clear? Yeah. So identification of an asset that may be impaired. It is not like that you go for impairment on every year and for every asset. So this is not a thing. You need to see if there is any indicator exists, then you are go for impairment, otherwise not. For example, in case of a car, you have purchased a car for 10 years, then 1 lakh rupees 10 years, and the cost was 10 lakh rupees, and the depreciation is 1 lakh rupees every year, right? So you are charging depreciation every year. But when there was a negative announcement by the government to ban the diesel car 6 months down the line or 1 year down the line, then only you have done the impairment testing. and then only you have calculate, you have just check the recoverable amount in terms of fair value. What is the fair value as of now, right? So if the fair value is declining, there is an impairment. So first of all, straight away you have not gone for checking the fair value, you have not gone for estimating the fair value. First of all, there was an indicator of impairment, there was an indication that this asset may be impaired, and hence when this asset may be impaired, and only then you have gone with the impairment testing and you have estimated the recoverable value, right? I hope it is clear to everyone so far. Clear? Friends, but there are some exceptions as well. There are some exceptions as well. What is the exceptions? In case of below assets, the impairment testing is required irrespective of the indications of impairment. But there are three assets, there are three intangible assets for which you are not required to see whether indicator of impairment is there or it is not there, whether COVID is there or COVID is not there, whether government announcement is there or government announcement is not there. You have to do the impairment testing at least once in a year on a mandatory basis. What are those kind of assets? What are those assets? Asset number one, intangible assets having indefinite. Do you remember I have told you indefinite life? Do you remember I have told you that there is a concept of finite life and indefinite life? In case of indefinite life, since life is not there, you are not able to estimate the amortization. Okay, so in that case, what you are required to do, in that case, you have to check the impairment, you have to do the impairment testing, right? So the first one is intangible asset having indefinite life. What is the second assets? Again, second asset is intangible asset not yet available for use. Do you remember in the intangible asset, I have told you the research phase and development phase. So the intangible asset which is under development phase, it is what? It is work in progress. Okay. So the intangible asset which is not yet available for use, for that kind of intangible asset, impairment testing is required on a mandatory basis, right? It is required on a mandatory basis. Number three, goodwill acquired in business combination, in amalgamation, right? So there was a business combination and there was a goodwill which is recognized in business combination. So goodwill recognized in business combination, for that kind of goodwill, impairment testing is required. Okay, for that kind of goodwill, impairment testing is required. So guys, what we are learning here, that impairment testing is not a straightaway exercise. First of all, you need to see if there is an indicator of impairment, you need to do the impairment testing. But there are three assets on which you are not required to wait for the impairment indicator. You have to do the impairment testing straight away, at least once in a year, right? But what about other assets? Apart from these three assets, what about other assets? What about other assets? For other assets, if there is an indicator, you have to go through with the detailed impairment testing. You have to calculate the recoverable amount. Okay, for other assets. But for these three assets, you have to do the detailed impairment testing and you have to calculate the recoverable value straight away, right? Is it clear? And let me put some notes for these kind of assets. Let me put some notes. Note number one, or note number A, the impairment testing is mandatory. I'm not saying impairment will be there, but you need to calculate the recoverable amount. You need to do the impairment testing. The impairment testing is mandatory on above three assets at least once in a year. Okay. Second, it says that the frequency and timing should be consistent for impairment testing. For example, in FY 2021, the impairment testing on these assets. So let me write these assets here. Intangible asset having indefinite life, right? Intangible asset not available for use. And goodwill, right? So these are the three assets. This is my FY 2021. This is my FY 21-22. Okay. So in this case, in FY 2021, intangible asset having indefinite life. For example, in this year, the impairment testing has been done in Q3, in third quarter. So in the next year, on this asset, this impairment testing should be done in Q3 only. For example, for intangible asset not available for use in the last year, the impairment testing has been performed in second quarter. So in this year, this has to be performed in the second quarter so that there is a difference of 12 months. Okay. So that there is a consistency there, so that there is a consistent frequency. Okay. So if it is Q2, every year it has to be done in Q2 if you are doing at least once in a year. For example, for goodwill, you have done in Q1. So you have to perform next year also in Q1 this impairment testing exercise on these kind of assets, right? So frequency and timing should be consistent for impairment testing on a year-on-year basis, right? I hope it is clear to everyone. Third point, and I would request each one of you to please make these notes. Third point, for example, an intangible asset having indefinite life is acquired in January 2022. Okay, January 2022. So now the question arises whether impairment testing is required on this asset in FY 21-22. Tell me, what is your view? This asset is acquired in this year only, and not only in this year, this is acquired just 3 months back in January 2022, right? So whether impairment testing is required in this financial year on this asset? Yeah, is it required? What is your view, guys? Yes, it is required. Standard says that even though if the asset has been acquired during the year, if these three assets have been acquired during the year, in that case, in that year, doesn't matter it is 2 months old or 3 months old, the impairment testing is required on the reporting date, right? So impairment testing is required at least once in a financial year, okay? So yes, impairment testing is required. Yes. Yes, in this case, impairment testing is required, right? Clear? So guys, I hope you are clear about this aspect, identification of an asset that may be impaired concept, right? So an entity shall assess at the end of each reporting period whether there is any indication that an asset may be impaired. If indication is there, then you need to estimate the recoverable value. But irrespective of whether there is an indication of impairment, an entity shall test annually for the below these kind of asset for impairment: intangible asset with an indefinite useful life, intangible asset not yet available for use, and goodwill acquired in business combination. On these three assets, impairment testing is mandatory, right? Impairment testing is mandatory. Clear? Now, what is indicator of impairment? Anyone can tell me what is the indicator of impairment? Have you seen the two indicators in your car, right and left indicator? So likewise, for impairment, there are two indicators. Likewise, for impairment, there are two indicators. And what are those indicators? What are those indicators? Internal indicator and external indicators. Internal indicator and external indicator. Right. So what indicates you that yes, we need to perform an impairment testing exercise? We need to estimate the recoverable value. We need to calculate the recoverable value. What motivates you? What inspires you? So if there are some indicator which says that there could be an impairment, so of course, when there is an indicator which says that there could be an impairment, then you will go for estimating the recoverable value, and then you will check actually whether there is an impairment or there is no any impairment, right? So first of all, if I talk about internal indicator, the first one is evidence of obsolescence or physical damage. Sir, is it a exhaustive list? This is not an exhaustive list. This is an indicative list. This is an inclusive list, okay, where some examples of internal indicators and some examples of external indicators are given, right? So the first one is evidence of obsolescence or physical damage. For example, you have a machinery in your godown or you in your factory, and that machinery got damaged. There is a car, and car met with an accident, right? So when car met with an accident or machinery got damaged, it is an indicator of impairment. It is an internal indicator of impairment that you need to check the recoverable value, right? For example, the value of a non-accidental car and the value of an accidental car are different, right? If there is an accidental car, of course its value will go down, of course, yes. So guys, evidence of obsolescence or physical damage is one of the internal indicator which says that you need to perform an impairment testing exercise, and you need to calculate the fair value less cost to sell or value in use. You need to calculate the recoverable value, right? Asset remaining idle. What is meant by asset remaining idle? You have purchased an asset. You have purchased an asset, and that asset was lying in godown since long. Or even though that machinery or asset is lying in your factory, but you are not able to use that kind of machinery or asset, right? Why? Because there is no demand. So it means the asset is not able to give you future economic benefit. Again, it is an internal indicator that you have to go to perform an impairment testing exercise. You have to go to calculate the value in use and the fair value less cost to sell. And if the asset is remaining idle, there is no value from using the asset because there is no use of that asset, right? So again, I'm not saying if these items are there, there must be an impairment. I'm not saying that. I am saying that these are the indicator of impairment. And if these indicators are available, you have to check whether impairment is there or it is not there. Discontinuance, disposal or restructuring plans, right? For example, long back, HSBC Bank has told that we will discontinue the private banking business in India. So what is this? This is kind of a restructuring plan. This is kind of a disposal plans. This is kind of discontinuance. For example, long back, Tata, Tata Nano plant. This Tata Nano plant was in Sangrur in West Bengal, right? From Sangrur, they have relocated to Gujarat. So again, it is kind of a restructuring. It is kind of a disposal or discontinuance. I can say that, right? So if there is a restructuring, if there is a discontinuance plan, there is a disposal plan, of course, that is an internal indicator of impairment. It is signifying that it is just indicating that there could be an impairment and you have to perform the detailed exercise. Declining asset performance, right? So time by time your asset has a declining asset performance. For example, the car was giving a mileage of 20 when we have purchased this car, and it declines to 18, then it declines to 17, declines to 15 and 10. Okay, so this car is significantly declining its performance. The mileage is getting declined. Okay, so if there is a declining asset performance, I am not saying there must be an impairment, but yes, it is an indicator of impairment, right? Is it clear? So Manikandan is asking, sir, in case if the asset was purchased in the month of March, even though in that financial year where we are required to do the impairment testing on the reporting date, yes. But whether there will be an impairment, answer maybe no. Why? Because you have recently purchased this asset. So of course, this fair value or market value will be similar what the value will be there on 31st March. There will not be any significant movement in the values, right? So probably the value has not been declined. Probably there will not be any significant reduction in the value, but yes, from the concept per se, you have to perform a mandatory impairment testing even though if the asset was acquired in the month of March, right? Jay is asking, sir, why assets remain idle? Jay, assets remain idle probably because of less demand, right? For example, the company has purchased 10 machineries and the company was anticipating that we have enough demand for that. Okay, but probably the demand was not up to mark and the company was able to use only 5 machinery. The remaining 5 machinery are remaining idle, right? So these were the internal indicator. Now we'll talk about the external indicator. Yeah, external indicators. So we have seen that the internal indicators is largely related to the operation, largely related to the management decisions. For example, physical damage, it is something which is internal. The machine has actually, or the asset has actually witnessed a physical damage. The asset is lying idle. The asset performance is getting down. The management has a disposal, discontinuation or restructuring plans, right? External indicator is something which is more from the market driven or which is more from the economy driven. For example, significant decline in market value. And I'll give you a classic example from my real life. 4 years back, not 4 years back, 3 years back, I have purchased a Samsung S9 Plus phone, and I have purchased that phone at 70,000 rupees to be precise. After 1 year, at the time of Diwali, so 3 years back, I have purchased this phone at the time of Diwali, and after 1 year at the time of Diwali, when I was looking at the Flipkart, okay, that phone was selling at 30,000 rupees. Can you imagine? So if the cost of the phone was 70,000 rupees and life is 3 years, so probably at the end of the first year, I was expecting the value should be 50,000 rupees or at least 45,000 rupees. But the value, that phone was available at 30,000 rupees. So there was significant decline in market value. There is a significant decline in market value, and hence it is an external indicator of impairment. If there is a significant decline in market value, it is an external indicator of impairment that you need to perform the impairment testing, and you need to calculate the recoverable value as a fair market, as a fair value less cost to sale or value in use, right? Changes in technological, market, economic or legal environment. So technological, if I talk about 10 years down the line, there was a keypad phones. Have you heard about Nokia 1100, Nokia 3100, Nokia 3500, right? So when Nokia was launched, these phones were keypad phones. Now the technology has been changed, and this keypad phones has been replaced with the Android phones, right? So the machinery which were manufacturing these keypad phones, of course, due to change in technology, It is an external indicator of impairment that those machineries needs to be impaired, right? Changes in economic environment. For example, this Russia and Ukraine war. What is this? This is again an external indicator of impairment. The steel prices are going up, the metal prices are going up, the fuel prices are going up. What is this? This is an indicator of inflation. This is an indicator of impairment, external indicator of impairment, because the market or economic environment is changing. Changing in legal environment. The government has come up with a notification that this diesel car will ban in India, or diesel car will ban in the state of Haryana. So this is again a notification from the government side. So this is a change in the legal environment, and if this change is there, so of course it is an external indicator of impairment, right? For example, the company has purchased a machinery from China, and the output which was produced by that machinery, government has told that you are not required to produce this output from this particular machine. This is not sellable. Government has banned that output. So the moment the government has banned that output, we need to impair that machinery. We need to calculate the impairment loss on that machinery. We need to estimate the recoverable value for that machinery. It is an external indicator of an impairment. Changes in interest rates. So guys, can you tell me why change in interest rate is an example, external indicator of impairment? Whether this change in interest rate is a higher interest rate or a lower interest rate. Tell me, what is your view? Tell me, friends, what is your view? So let me move to my PPT, sorry, Excel file. Indicators of impairment, right? Internal indicator and external indicator. Internal indicators we have talked about. Now we are talking about external indicators, right? While talking about external indicators, I have told you the change in interest rate. Change in interest rate. It is an indicator of impairment, right? So first of all, for example, the carrying value of an asset is let's say 100 rupees, right? Now we need to calculate the recoverable value. What is my recoverable value? What is a recoverable value? Recoverable value is higher of fair value less cost to sell and value in use. Assuming my fair value less cost to sell, assuming my fair value less cost to sell is, let's say, 90 rupees, or let's say 80 rupees, right? 80 rupees. What is my value in use? What is my value in use? My value in use is equal to present value of future cash flows. Present value of future cash flows. So assuming my future cash flow is 100 rupees. Assuming my future cash flow. So my cash flow after 1 year, it will come, my cash flow after 1 year is 100 rupees. Interest rate is, for example, or discount rate is, for example, 10%. What is the present value? What is the present value of this future cash flow? What is the present value? 100 divided by 1 plus 100 divided by 1 plus 10%, right? Sorry, 100 divided by 1 plus 10%. Okay, so this should be in, not in so it comes out at 90.91, right? So the present value is 91. Assuming with the same example, my cash flow is 100 rupees after 1 year. The interest rate has been increased from 10% to 15%. Then what is my present value? My present value is 87 rupees. So guys, if there is a change in interest rate, when the interest rate is increasing from 10, it becomes 15. When the interest rate is increasing from 10, it becomes 15. Then what will happen? My present value is decreasing. My value in use is decreasing. It means in the market, if the interest rate is increasing, it is an external indicator of impairment that your value in use may decrease. Why? Because while calculating the present value, you have to apply a discount rate. And what is a discount rate? It is an interest rate, right? So if the interest rate will be higher, if your denominator will be higher, of course, your numerator will go down. Your present value will go down. Okay, is it clear? So hence the change in interest rate, it is not a decline. It is an increase in interest rate is an external indicator of impairment, right? It is an external indicator of impairment. I hope it is clear to you guys now. Friends, I hope it is clear to you guys. Yeah. Clear? Now let's go to the next one. Low market capitalization. What is low market capitalization? If you see the balance sheet of Vodafone Idea Limited. So the Vodafone Idea Limited market valuation or market capitalization is less than 15,000 crores. But their asset base is more than 1 lakh crores, right? So if the market capitalization, if the market value of a company has gone down significantly, the market capitalization is lower than the value of the assets, it means market does not have a trust over the business to the extent that business is having a value of the assets. Okay, so it means the value of the assets does not have that kind of synergies. Okay, and again it is an indicator, external indicator of impairment, that if the market capitalization becomes lower or the market capitalization is declining, it is an indicator of impairment, external indicator of impairment, that you need to go for the impairment testing for your assets, right? Is it clear? Is it clear, friends? Yes, no? Yeah, so I got the confirmation from 3-4 students. Yes, it is clear. Yeah. So friends, when we have talked that in case of, identification of an asset may be impaired, you have to check if there is an indicator. You need to go with the detailed impairment exercise, right? You need to calculate the recoverable value. So what are those indicators? These indicators are my internal indicators as well as my external indicator. If these indicators are there, then you can say that, okay, since these indicators are there, now I have to do the impairment testing in detail. Okay, I have to do the impairment testing in detail. Is it clear? Is it clear? Clear, guys? Yeah. But there are three assets. On which you are not required to see these kind of impairment indicator. You have to do the impairment testing mandatory at least once in a year. The frequency should be consistent. If the asset has been acquired in a year, it has to be once in that financial year. You have to do the impairment testing at least once in a year, and you have to do in that year, even though you have acquired that asset in that year only, right? Is it clear? Now let's discuss the concept of recoverable amount. So guys, it's 8:15 now, so let's have a 10 minutes break, okay, before starting the new concept. So we will start at 8:25. Okay, Yeah. So students, let me see if you have any query. So I'll do that. Jay is saying indicators of impairment is equal to indicators of entity, not a going concern. Jay, your question is not clear. Indicators of entity, not a going concern. Jay, you are right. So for example, if there is an impact on a going concern, of course, in that case, you need to do the impairment testing. So going concern is again an indicator of impairment, right? Now coming to the recoverable amount, so far we are clear that recoverable amount is higher of fair value less cost to sell and value in use. What is fair value less cost to sell and what is value in use? So guys, again, let me come back to my Excel file. Recoverable amount. And this recoverable amount is nothing. It's a higher of. It's a higher of what? Your fair value less cost to sell. Fair value less cost to sell and value in use, right? So higher of fair value less cost to sell and value in use. So friends, now let's understand what is fair value and what is the value in use. If I talk about fair value, so fair value is a market driven value, right? But if I talk about value in use, it's a entity driven value or entity specific value. Entity specific value. Okay. So the first one is fair value means market value. If there is a car, Swift car, so I am holding a car, Sai Ram is holding a car, Jay is having that car, Srinidhi is having the same car. So for four of us, what is the fair value of that car? It is a market value, right? But what future economic benefit four of us are deriving, it depends on our actions. It depends on how we are using that asset. If Srinidhi is using that asset as a passenger car, if I'm using this asset in my office for let's say taking my employees from residence to office, right? So I have a different usage. Jay is using that car just typically for the top management, so Jay has a different usage. So value in use is an entity specific value which provides that what cash flow the entity will generate by using that asset. Okay, so hence it is an entity specific value. It is not a market driven value, right? So fair value is something where you can derive a value. Value can be derived more from the exit point of view, more from the exit point of view. What is exit point of view? For example, from sale. Okay, if you want to sell the asset, if you will sell the asset, at what value this asset will fetch by selling that asset into the market. For example, this is a marker. So the cost of the marker or carrying value of marker is 10 rupees, right? So if I'll go into the market and sell this marker, what price this marker will fetch is a fair value less cost to sell. So fair, it is a fair value. And whatever cost I will incur while selling this asset, it will be my cost to sell, right? If I will use this marker till the life of this marker, if I'll use this marker, what value I will derive, what value I will fetch by using this marker is a value in use. And value in use includes the cash flow which arrived during the usage of the asset plus the cash flow which is terminal cash flow like scrap sale, right? So it includes the cash flow by using the asset plus cash flow by selling that asset at the end of its lifetime as a scrap sale or as a terminal cash, right? So I hope it is clear to everyone. So value in use is more from a market perspective. Value in use is more from an entity perspective. Fair value is more from it is derived from the exit point of view from sale, but value in use is derived from the use, right? So this here value can be derived from the usage of the asset. Value can be derived from the usage of the asset, right? I hope it is clear to everyone, friends. I hope it is clear to everyone. Is it clear? Yes? No? Yeah, great. So we are clear on fair value less cost to sell and value in use. Now, tell me one thing. So my carrying value for an asset is, for example, 200 rupees. My fair value less cost to sell is, for example, 150 rupees. My value in use is 140 rupees. So what is my recoverable amount? My recoverable amount is higher of these two items. So my recoverable value is higher of fair value less cost to sell and value in use. Recoverable value is 150. And what is my impairment loss? My impairment loss is 200 minus 150, right? It is 50 rupees, right? Now tell me one thing. There are 2 lakhs of recoverable amount, fair value less cost to sell and value in use. Again, in the same example, this is my carrying value. And when I have calculated my fair value less cost to sell, it comes out at 210 rupees. Do I need to calculate value in use? Do I need to calculate value in use? Or vice versa, the carrying value was, let's say, 200 rupees and the value in use comes out, the VIU comes out at, let's say, 210 rupees. Yeah, same example I'm taking. So in the first example, do I need to calculate VIU? In the second example, do I need to calculate FV minus CTS? Do I need to calculate FV minus CTS? Tell me, friends, in this example, carrying value is 200 and fair value less cost to sell is 210. Do I need to calculate value in use? So guys, the concept of recoverable amount is higher of fair value less cost to sell and value in use. So if the concept is higher and fair value is already, it is higher than the recoverable, higher than the carrying value. So at least it will not go less than 210, right? Your recoverable value will not go less than 210. If the value you use will be, let's say, 100 rupees, but still you have to take a higher value, which is 210 rupees. So the minimum level is defined already, and this minimum level is more than your carrying value. In that case, there is no need to calculate your next leg. Okay. Same way, if value in use is 210, so we are not required to calculate fair value because this is already higher than your carrying value. There is no impairment at all. Doesn't matter if the second leg, for example, fair value less cost to sell is 50 rupees, doesn't matter. Your value in use is still higher than the carrying value, right? So friends, if you have calculated a fair value or market value and it is already higher than the carrying value, then there is no point to calculate value in use, right? Or vice versa. Clear? Yeah, you're right, Priya. Right, Jay? Good, guys. Now let's discuss what is fair value, right? And before discussion of fair value, let's come to this case study. So recoverable amount is higher of an individual asset or group of assets, fair value less cost to sell or value in use, right? It is not necessary to calculate both an asset fair value less cost to sell and its value in use. If either of these exceeds with assets carrying amount, the asset is not impaired, right? Yeah, what is the answer of this case study? Very simple, very small illustration. The carrying value of a building in the books of Sun Limited on 31st March is 300 lakhs, carrying value is 300. As on that date, the value in use is 250 and fair value less cost to sell is 238. So what is recoverable value? It is higher of VIU is 250 and FVCTS is 238. So what is my recoverable value? My recoverable value is 250. And what is my impairment loss? My impairment loss is carrying value minus recoverable value. It is 50 rupees. Okay. So it is 50 rupees. Clear? Your recoverable amount is 250, your impairment loss is 50. IL is equal to 50. So friends, now let's discuss the first leg, fair value less cost of disposal. What is a fair value? I have told you that fair value is a kind of a market value. And from where the definition of fair value has been given, the definition of fair value has come from Ind AS 113 fair value measurement, right? And what is the definition of fair value? Fair value is a price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. We are more concerned about asset, right? So what is a fair value? It is a price which will be received to sell an asset. I have told you that the fair value is more from the perspective of exit point of view. It is more from the perspective of disposal of an asset. So what price an entity will receive by selling an asset? And of course, it should be an orderly transaction. It should be between the market participants and at a measurement date. This fair value concept, valuation concept is on the basis of a measurement date, right? So date is very important. The measurement is very important, right? So friends, when I talk about orderly transaction between market participants, it means it is a fair transaction. It should be not, this transaction should not be arised out of coercion, out of undue influence, right? It should not be at a gunshot. It should be a fair transaction. So fair value should be a fair, its fair value should be a fair value. Okay. So this is a definition part only. Largely it is a market value. What is the cost of disposal? When I talk about cost of disposal, it is my incremental cost. If I would not have sell this asset, this cost would not have been incurred. So my cost to disposal is an incremental cost. Okay. So incremental cost of disposal. For example, if I have to sell my land, if I have to sell my building, so I will have to incur a brokerage. I will have to incur a commission. I may end up paying some stamp duty, for example, right? So these kind of expenses are incidental and related to the sale or disposal of the asset, right? But if I'm getting the valuation done for my building and I have paid a valuation fee of 50,000 rupees, is it a cost of disposal? Whether this valuation cost is directly related to the sale of the asset? Guys, this is a sunk cost. This is not a cost of disposal from the perspective of fair value less cost to sale. This is not a directly related cost of disposal. Why? Probably I am doing this valuation exercise, and after getting the valuation done, probably I can say that I will not, I don't want to sell this property right now. Okay. So this valuation cost which I am incurring as of now for getting the valuation of my property will help me in the decision making, whether I should go for a sale, I should not go for a sale. It is helping in my decision making. It is not directly related to the sale of the asset. And if I will help you to understand, sir, which cost will become under cost to sell and which cost will not come, once you have decided to sell the asset, whatever cost incurred after that will become part of your cost to sell for calculating fair value less CTS. So valuation cost is something which will give you, which will help you in taking a decision whether you should go for a sale or you should not go for a sale. Okay, whether you should go for a sale or you should not go for a sale. Okay, is it clear? Understood? So cost of disposal is an incremental cost directly attributable to the disposal of an asset or group of assets, excluding finance cost and income tax expense. You are saying that, sir, if I will sell this property, I will have a capital gain. For example, the fair value is, let's say, or sale price is, let's say, 20 lakh rupees. And you are saying that, sir, the market price is 20 lakh rupees, but why you are taking 20 lakh rupees only? I will end up paying 4 lakh rupees of taxes as well. So in my hand only 16 lakh rupee will come. So should I reduce income tax expense also while calculating fair value less cost to sell? Answer is no. This cost of disposal excludes finance cost and income tax. Please remember this. In examination, probably the question will be tricky and question will be there to make you confused, to confuse you that the fair value less cost to sell is 20 lakh rupees and there may be a capital gain worth 4 lakh rupees and in the hands of the entity there will be a 16 lakh rupees. Okay, so don't get confused. Cost of disposal includes only those costs which incur after taking a decision of sale, first of all. Second, cost of disposal does not include finance cost and income tax expenses. It does not include finance cost, it does not include income tax expenses, right? Is it clear? What could be the example of cost of disposal? Legal duty, legal cost, stamp duty, and similar transaction taxes. Cost of removing the asset. If you have to sell the asset, you have to dismantle the asset, you have to dispose the asset, right? So cost of removal. Directly incremental cost to bring an asset into condition for sale. For example, if you have to sell an asset, you have to do a special packaging, right? For getting it into a condition for sale, right? In this case, this special packaging kind of cost is in cost of disposal, right? So if you can see these examples are directly related to cost of disposal. Why you will remove the asset? You will remove the asset because you have taken a decision to sell that asset, right? Why you will incur a incremental cost for bringing the asset into condition for its sale? Because you have already taken a decision to sell the asset, right? Clear? Good. Let's do this example to understand fair value less cost to sell concept. ABC Limited owns a bottling plant located in one of its factories. So there is a bottling plant, like in case of in case of liquor industry companies, or in case of mineral water companies, these kind of bottling plants are there, right? So ABC Limited owns a bottling plant which is located in one of its factory. The professional valuers have estimated that the current market value of the plant is 10 lakh rupees, right? So the fair value of this plant is 10 lakh rupees. The valuation fee was 1 lakh rupees. Whether this valuation fee is a directly incremental cost, whether this valuation fee will be considered as a cost to sell. Yeah. Ayush is saying no. Okay. What about others? Megha is also saying no, sir, because this is a cost which is incurred for a decision making. Okay. What about others, guys? Yeah. What about others? Yes, this valuation fee is not a directly incremental cost. This valuation fee, because until and unless you will not get the valuation done, how will you estimate the fair value? How will you get to know what is the worth of your asset? So this is kind of a decision making cost. Okay, and after this valuation, probably you will take a decision that okay, I will sell this asset or I will not sell this asset. But if I talk about stamp duty, if I talk about brokerage, if I talk about commission, if I talk about cost of removal, if I talk about special packaging cost, so these kind of costs have been incurred after taking a decision that I'll sell the asset. Okay, I'm not saying that you cannot get back the decision, you cannot back from your decision, but of course you will take a decision, and only after that you are going to incur these kind of costs. Once you dismantle the asset, once you remove the asset, so there is a less probability that you will reinstall the asset. Okay, so so guys, valuation cost is kind of a sunk cost. It has to go to the P&L. It will not be considered while considering the fair value less cost to sell for the purpose of impairment testing, right? And hence it is not a inclusive cost, right? ABC need to dismantle the plant and deliver it to the buyer. ABC need to dismantle the plant and deliver it to the buyer. Dismantling cost is rupees 2 lakhs, right? So first, if this company wants to sell this plant, it has to be dismantled. It means dismantling cost is there. Whether this dismantling cost of removal is a part of cost of sale, yes, it is a part of cost of sale. And it also includes a specialized packaging cost of rupees 1 lakh and legal fee of rupees 0.5 lakhs. Yes, these are the cost to sell. Determine its fair value less cost to sell. So my fair value is 10 lakh rupees. Then dismantling cost, packaging cost, and legal fees is 3.5 lakh rupees. 6.5 lakh rupees is fair value less cost to sell. It is fair value less cost to sell, right? Is it clear? Is it clear, friends? Yes or no? Yeah, good. Now coming to the value in use. What is value in use? So value in use is nothing. It's a present value of future cash flows. So what in future, what cash flows you are expecting? And when I'm saying future, it is of course an estimation, right? So for calculating a value in use, two things are very important. One, estimation of future cash flows, and the second one is discount rate. First, you need to estimate the future cash flows. For example, there is a machinery, and life of the machine is 10 years, right? So first you need to estimate what is my cash flow over a period of 10 years. You need to estimate the cash flow, right? So what is my cash flow over a period of 10 years plus terminal cash flow at the end of 10 years, when the life will come to an end for this machinery, what is a scrap value? So you need to estimate the cash flow. Then you need to apply a present value factor, which is a nothing discount rate, right? For example, I am estimating today that after 10 years for this 1 crore rupees of machinery, I will have a terminal cash flow of 1 lakh rupees. But this is after 10 years. So what is the value in use today? So I need to calculate the present value of this 1 lakh rupees, which I'll receive after 10 years, right? So after estimating the cash flow, you have to apply the present value factor, and cash flow multiplied by present value factor will give you the present value as on date, will give you present value as on date, right? So friends, this present value is nothing, it's a value in use. It's a VIU, value in use. Okay. So two things are very important. One, estimation of future cash flows, and the second one is discount rate to be used. Why? First, you need to estimate cash flow, then you need to discount this cash flow. And for discounting this cash flow, discount rate is very important, right? So friends, before getting dive into the theory, first of all, I am taking you to the practical example. Okay. So in this case, in value in use, of course, you need to estimate the cash flow. What is included in cash flow, what is not included in cash flow, we will discuss that in the next session, right? But today we will do some practical case study so that you will be able to understand the concept of value in use, the concept of impairment, the concept of recoverable amount, right? And in value in use, there are two kinds of value in use. One is the value in use in the Indian currency and the value in use in the foreign currency, right? So, sir, if my asset will provide future economic benefit in foreign currency, then how to calculate the value in use, right? So standard says that, first of all, estimate future cash flow in the currency in which they will be generated. Your cash flow should be in the same currency in which it is generating, right? Then you have to use the discount rate using for that appropriate currency. For example, you are generating cash flow in India, so you have to estimate cash flow in Indian rupee. You have to apply the discount rate which is applicable to the Indian economy. But if you are generating cash flow in USA, you have to estimate the cash flow in US dollar, and you have to apply the discount rate which is applicable to the US dollar, applicable to the US economy. Why? Because the discount rate, the interest rate varies from one country to another country. In India, you are getting a loan at 8% or 9%. In Abu Dhabi or in UAE, you are getting a loan at 4%. In USA, you are getting a loan at 3% or 4%, right? So interest rate is different from one country to another country. So guys, standard says that for calculating a value in use, you have to estimate the value in use in the same currency in which it is generating. You have to apply the discount rate relating to that territory or that currency, right? And after that, you need to translate the present value using the spot exchange rate, right? So this is an important case study. This is an important part in the examination. Probably you may get a question where there is a cash flow in the foreign currency. There is a discount rate which is given for Indian rupee as well as foreign currency. In that case, how you will estimate the value in use? How will you calculate the value in use? That is very important. So friends, we will understand this concept with the help of this particular case study. On 31st March 2001, XYZ Limited makes following estimate of cash flow for one of its asset which is located in USA, right? And this cash flow in US dollar is there. Will you convert this cash flow in Indian rupee? Answer is no. Step one, please write step one. Step one, estimate the cash flow in the same currency, in which it is generating. So what you will do? You will take cash flow in the same currency. You will take the cash flow in US dollars only. Okay. First, second, and third year. Okay. Second, step two, apply discount rate applicable to that currency. Applicable to that currency. Right. Step number three. Step number three. Calculate value in use in that currency. So your value in use will be calculated in US dollar only, and translate using spot exchange rate. Right? So for future, you have estimated the cash flow in US dollars. You have to apply the discount rate which is applicable to US dollar. It will give you present value. Today. So once you have a present value, once you have a value in use today in US dollars, you will convert this today's present value. You will convert this today's value in use. Using the spot rate, using the today's rate for converting into INR, right? So friends, in this question, 3-year cash flow is given. The discount rate applicable to India and USA is given. So since the cash flow is in US dollar, so we have to take a discount rate applicable to US only. The exchange rate is also given, which is 31st March 2001, 45 rupees per US dollar. And for the next year, 31st March 2002, 3 and 4 exchange rate is given. So these exchange rate are not important. Why? Because you have to calculate value in use in the foreign currency. Then you have to convert this present value, this value in use in foreign currency into Indian currency. And for that, you have to use a spot exchange rate on 31st March 2001. So in this question, only 45 rupees per US dollar on 31st March 2001 is important, and this data is not important. Calculate value in use as on 31st March 2001. Okay. So let's solve this case study, solve this question on Excel file. Value in use calculation in case of foreign currency cash flows. In case of foreign currency cash flows. Value in use calculation in case of foreign currency cash flow, right? So first of all, write down the steps. I'll write step here also just for your benefit, so that once you will have an Excel file, you will have these steps readily available. Step 1, calculate the cash flows, calculate the future cash flows in foreign currency only. Step number 2. Estimate the discount rate. Estimate the discount rate applicable to the foreign currency. Step number 3. Calculate value in use. Calculate value in use in the foreign currency. And convert the VIU. Convert the VIU into Indian currency or reporting currency, right? Using spot rate. Right? I hope the steps are clear to everyone. Yeah. Now do this. Let's do this case study. Let's solve this case study. So first of all, solution to the case study, right? First of all, I'll write year on the left side. Okay. So 3 years were given: 2001 to 2002, 3, and 2003 and 4, right? So these are the years which are given, and the cash flows in US dollars are given. Cash flows in USD. Cash flows in USD are also given. Cash flows in US dollar is also given. And what is this? This is in the first year it was $80, $100 in the next year, $20 in the third year. 80, 100, and 20. And the discount rate was given. Discount rate was 15% for US dollar, right? So present value, sorry, 10%. It was 10% for US, and it was 15% for India, right? So my present value factor at the rate of 10%, which is for US. So what is the discount rate, guys? 10%. And what is the present value factor here? If it is 10%, is equal to 1 divided by 1.1 divided by 1.1 equal to divide by 1.1, right? So this will be my discount rate. Now what is my present value? What is my discounted cash flow? My value in use is the present value, right? So what is my present value? What is my discounted cash flow? Present value of cash flows. What is my present value of cash flows? It is my 170.40 is my present value of cash flow. 170.40. So remember 3 steps. Step 1, calculate cash flow in the foreign currency. Step 2, calculate discount rate or apply discount rate in foreign currency. Then you need to calculate value in use. So this is my VIU, value in use in USD, right? Now I need to convert this value in use in INR. So how to calculate this value in use in INR? So VIU in INR. How to calculate? Exchange rate. INR versus dollar. INR versus USD. It is 45. Exchange rate is 45. The spot rate is 45, right? So 170.40 multiplied by 45 comes out at 7667.92. To be precise, it is 7668. Guys, let me know if you have any problem, any issue, any concern in understanding this concept of value in use calculation in case of foreign currency cash flows. Let me know if you have any problem, any doubt. I hope it is clear to everyone. Yeah. I hope it is clear to everyone. Clear? Great. So let me share my presentation again. So we have discussed that in case of a foreign currency future cash flows, we have to estimate cash flow in foreign currency. We have to apply discount rate for foreign currency. We have to calculate value in use in foreign currency. Then we have to convert using the spot rate, right? Clear? Now let's do illustration number 3. Mars Limited gives the following estimate of the cash flows. Mars Limited gives the following estimate of the cash flows relating to property, plant and equipment on 31st March 2004. And this is a comprehensive kind of question which will clear all your concept, which will revise your concept, which will clear your concept, right? So Mars Limited gives the following estimate of cash flow relating to PPE on 31st March 2004. So this information is given for 31st March 2004 for a property, plant and equipment. The discount rate is 15%. And discount rate is given in this question. For calculating value in use, discount rate is very important. In the next year, 2004-5, cash flow of 2000 lakhs is there. In 5-6, 3000 lakhs cash flow is there. In 6-7, 3000 lakhs of cash flow is there. In 7-8, 4000 is there. In 8-9, 2000 lakhs cash flow is there. So these are the cash flows for first, second, third, fourth, and fifth year. And there is a residual value cash flow. So this is the regular cash flow. This is the regular cash flow. And there is a terminal cash flow also. At the end of the life of the asset, there is a terminal cash flow. And the terminal cash flow of 500 lakhs is also given, right? So total cash flow of 2 plus 3 plus 3 plus 4 plus 2 plus 500 is there. So these are the cash flows, right? And it was also given, so these informations are given on 31st March 2004 for future. And this property, plant and equipment was purchased on 1st April 2001 for rupees 20,000 lakhs. So these informations are given on 31st March 2004, and this PPE was purchased 3 years back, 3 years prior to 31st March 2004. Okay. So this was 20,000 lakhs and the useful life was 8 years. So here 5-year useful life is there after 31st March 2004. And on 31st March 2004, 3 years has already elapsed. So this asset was purchased on 1st April 2001. And the information given is 31st March 2004, right? So 3 years have already gone out. Yeah. So now 5 years are left for which information is given. And you have to calculate something on 31st March 2004. The useful life was 8 years. The residual value estimated at the end of 8 years is 500 lakhs, which is given in the question. And the fair value less cost to sell on 31st March 2004 is given, which is 10,000 lakhs. So in this question, some informations are given on 31st March 2004. The discount rate is given. The cash flow is given. So if the discount rate is given and the cash flow is given, we can arrive at a value in use on 31st March 2004, right? And when we compare value in use with fair value less cost to sell, which is given in the question, we can arrive at a recoverable amount, right? We can arrive at a recoverable amount. And in this question, the cost of acquisition of 20,000 lakhs is given on 1st April 2001. If the cost is there, we can arrive at a carrying value on 31st March 2004, right? So for calculating an impairment loss, we need to have two information. One is your carrying value. The second one is recoverable value. As far as recoverable value is concerned, in this question, the fair value less cost to sell is given. And the data relating to value in use is given. Discount rate is given, cash flow is given. We can calculate present value, right, of the discounted cash flow. And if that date of acquisition is given and the cost of acquisition is given, we can calculate carrying value as well on 31st March 2004. So once we have a carrying value, once we have a recoverable amount, we can calculate impairment loss as well, right? So this is a comprehensive kind of question where we will calculate recoverable value, where we will calculate carrying value, where we will calculate impairment loss, and where we will calculate the future depreciation as well, right? So we'll do all these things in this particular question. I hope the question is clear to everyone. And let follow me on the Excel file just to solve this case study, solve this illustration number 3, right? Illustration number 3. Solution to illustration 3 of ICAI study material. So friends, in this question, there are 4 asks. Okay. Calculate recoverable amount, carrying amount, impairment loss, future depreciation. Yeah. So let's calculate one by one. Let's calculate one by one. Working number 1. I hope my Excel file is visible to everyone. Yeah. So working number 1. Calculation of carrying amount. Calculation of carrying amount. What is the cost? What is the cost? Cost is 20,000 lakhs. The number is in lakhs. Cost is 20,000 lakhs, right? What is the depreciation? What is the depreciation per annum? What is the life? Life is 8 years. 8 years. What is my per annum depreciation? Depreciation per annum. My depreciation per annum is 20,000 divided by 8. 2,500. What is my accumulated depreciation for 3 years? Accumulated depreciation till 31st March 2004. What is my accumulated depreciation? 2,500 multiplied by 3. 3 years have gone out. So my carrying value is equal to, carrying amount is equal to cost minus accumulated depreciation. 12,500 is my carrying amount, right? 12,500 is my carrying amount. Sorry, I have missed one thing. In this question, the scrap value is also given. In this question, scrap value is also given. Scrap value. Residual value is given, right? Residual value. My mistake. So what is the residual value? Residual value is 500 lakhs. So what is the depreciation per annum? 20,000 minus 500 divided by 8. Right? 2437.5 per annum. And when I multiply this with 3, it will give me 12,688. I hope this is clear to everyone, friends. I hope this calculation is clear to everyone. Let me know if there is any challenge in this calculation. Yeah. Good. Second calculation. Calculation of value in use, right? After that, we will calculate the recoverable amount. Calculation of value in use. For calculating value in use, first of all, let's plot the years. And what are the years? So 4-5, 2004, 5, 2005, 6, 2006, 7, 2007, 8, 2008, 9. Okay. And in 2008-9, there are 2 values. In 2008-9, there is one recurring value and there is one terminal value. Okay. So again, 2008-9, there is a terminal value as well. And what are the values? What are the cash flows which are given? What are the cash flows which are given? 2,000 in the first year, 3,000 in the second year, right? 3,000 in the third year, right? 4,000 in the fourth year, 2000 in the 5th year, and 500 is the terminal value, is the scrap value which is given in the question, right? Which is given in the question. The total cash flow is 14,500. Now, what is the discount rate? What is the present value factor? So your present value factor, what was the discount rate? It was 15%. Remember, it was 15%. So present value factor at the rate 15%. 1 divided by 1.15, right? So it comes out at 0.87. Then divide by 1.15, it will give you second year, so on and so forth. It will give you for 5 years, right? And the last year is also same. The last one will also be same. Okay, so this is the discount factor, and after that it is present value. So your present value PV. So this will be 9510. This will be 951, 9,510 lakhs. Okay. So we have calculated fair value in use. We have calculated carrying amount, and the fair value less cost to sell is also given in the question. What is my fair value less cost to sell? Fair value less cost to sell is given in the question. It is 10,000 lakhs. It is 10,000 lakhs, right? Now calculate recoverable amount. Calculate recoverable amount. So how to calculate recoverable amount? First of all, you need to put fair value less cost to sell. What is my fair value less cost to sell? It is given in the question 10,000. What is my VIU? It is calculated at 9510. Right. So what is higher? What is higher between these two items? 10,000 is higher, and 10,000 will be my recoverable amount, right? Recoverable amount. 10,000 is my recoverable amount. Now, what is my impairment loss? What is my impairment loss? My impairment loss is carrying value minus recoverable value. My carrying value was how much? My carrying value on 31st March 2004 is 12,688. What is my recoverable value? It is 10,000. My carrying value minus recoverable value is 10,000, right? What is my impairment loss? My impairment loss will be, okay. So what will be the accounting entry? So your accounting entry will be impairment loss account debit. Your accounting entry will be impairment loss account debit to impairment loss account debit to your asset account, to PPE, right? So how much is the amount? 2688, right? Now what will be the new? What will be the revised carrying value? What will be the revised carrying value? Revised carrying value as on 31st March 2004. What is the revised carrying value? Of course, the revised carrying value will be 10,000 only, right? Because the carrying value was 12,688, and you have debited impairment loss and credited PP by 2,688. So what is the balance which was left? It was 10,000, right? It was 10,000. Clear? And what will be the revised depreciation? Now, next, last part, D part. Calculation of revised depreciation, right? So guys, and how much life is left? Remaining life is 5 years. Remaining life is 5 years. what is your residual value? Residual value is 500, which you will receive after 5 years, right? And what is the carrying value today? The revised carrying value is 10,000. So revised depreciation is equal to revised depreciation. Your 10,000 is the revised carrying value. You will receive 500 after 5 years. Divided by life is 5 years. So this will give you 1900 of depreciation. So your revised depreciation will be 1900. I hope it is clear to everyone, guys. I hope this case study is clear to everyone. Yeah, Jay, Srinji, Priya, Sairam. Is it clear to everyone? Friends, is it clear to everyone? Yes or no? So this was the illustration. So we have covered this. We have calculated the carrying value. Then we have calculated the value in use. Then we have calculated the recoverable amount and impairment loss. And then we have calculated the revised carrying value and revised depreciation. Right? So we have calculated all these aspects. So friends, so far we have understood the concept of value in use, how this value in use is going to be calculated. Right? Now let's discuss the concept of this value in use. Right? What will be included, what will not be included in the cash flows. So first of all, we understood that for calculating value in use, two things are important. One, you have to project cash flows. The second one, you have to estimate the discount rate, right? So one, projection of cash flow is important. Second, estimation of interest rate is important, right? So we'll discuss one by one. That what value in use reflects, what are the element which is reflected in the value in use. Estimate of the future cash flow of the entity expect to derive from the asset, right? So whatever cash flows we are expecting, of course, it is from the underlying asset. It is from the underlying asset. So we need to estimate the cash flows only from those assets which are going to be impaired, right? Or for which you are calculating the value in use, for which you are doing the impairment testing. Expectation about possible variation in the amount of timing of those future cash, right? So you need to estimate the possible variation in the timing as well. When will be my terminal value will come, of course. So terminal cash flow will come at the end of the life of the asset. So at the end of first year, second year, third year, you have to project very carefully that what will be my cash flow at a different point of time, right? So expectation about possible variations in the amount or timing of those future cash flow, you have to take into the consideration, right? For example, if the asset is new, of course, in the initial 2-3 years, the asset will have a very good output. But after 3 years, 4 years, probably the asset will demand some repair and maintenance. The performance of the asset may go down. So you should talk about, you should be, clearly project what could be the possible variations from the cash flow of this particular asset in terms of timing, in terms of amount. So you have to project that. Time value of money, of course, this value in use is nothing, it's a time value of money. For example, if the cash flow which is going to be derived after 1 year, 2 year, 3 years, so the value of that cash flow today is not same. It should be a discounted cash flow. If I'm earning 5 lakh rupees after 3 years, so that 5 lakh rupees after 3 years will not be same 5 lakh rupees as on today, right? So other factors you need to consider, for example, market related factors, for example, other technological factors you need to consider while estimating future cash flow. So the thing is very clear. If you need to estimate future cash flow, it should be from the asset which is underlying asset, right? You have to take a consideration of possible variations. You have to take a discount rate which is an appropriate discount rate for discounting the cash flows, for arriving at a value in use, right? Coming to the basis for estimate, standard says that the cash flow estimate should be reasonable and supportable assumption of management best estimate of the economic condition over the remaining useful life of the asset. So it doesn't mean that, sir, we are talking about future. So probably what can I do? I can say that my asset will provide a future economic benefit, or let's say cash flow, for the next 10 years. So guys, my dear students, as an auditor, will you buy that point? If you are an auditor and management is saying, okay, my machinery will provide 10,000 crores in the next 10 years, will you buy this point? Answer is no. You will ask for some logic for that. You will ask for some supporting assumptions for that, right? What are the supportable assumptions, right? And how you have arrived at those supportable assumptions. For example, management will say that the similar machinery in my company or in the market is providing such a kind of outflow, right? Or the economic life, or let's say the life is already printed on the invoice of the machinery. The technical life is 10 years, for example, right? So you should have a supportable assumptions for that. Greater weight should be given to the external evidence. For example, the technical life is 10 years. So the greater importance, greater weightage should be given for external evidence, not for the internal evidence, right? So these are the basis that for estimating, because the future cash flow is an estimate. And for estimating the future cash flow, you have to provide more weightage, more importance to the external evidence, and your cash flow, your projection should be reasonable, and supportable assumptions will be there, should be there for those cash flow projections. While doing the cash flow projection, you have to use most recent financial budget or forecast that have been approved by the management. While calculating value in use, you will estimate future cash flow. And while estimating future cash flow, you have to estimate the most recent financial budget and forecast, right? Most recent financial budget and forecast which have been approved by the management. Projection, and sir, what could be the length of the projection? The length of the projection should be at least should be maximum for a period of 5 years, right? Sir, can we do the projection for 20 years, 30 years just to avoid the impairment? Answer is no. Standard says that you have to measure, you have to calculate the value in use, you have to estimate the cash flow projection for a period of 5 years, for a maximum period of 5 years, until and unless beyond 5 years is justified. Until and unless beyond 5 years can be justified, right? So it should be for a maximum period of 5 years. Okay. Sir, what could be included in cash flow? So first of all, we have discussed what are the elements which needs to be reflected. So first, the estimate should be from the asset only. The possible variation during the lifetime of the asset should be clearly inbuilt into the cash flow projections, and the time value of money should be given an equal weightage, right? What could be the basis? The basis should be logical. The reasonable assumption and supportable assumption should be there. The greater weight should be given to the external evidence. Most recent financial budget or forecast should be used, right? And projection should cover a maximum period of 5 years, right? What are the inclusions in cash flow? So cash flow should be estimated for asset in their current condition. For example, today you are estimating a cash flow. Today you are doing an impairment testing exercise. Today you want to calculate a value in use. The life of the asset is 10 years and this asset is 4-year-old asset. So while estimating the cash flow, you cannot estimate the cash flow from the perspective of new machinery. You have to estimate the cash flow from the perspective of a 4-year-old machinery, right? You cannot say that, oh, new machinery will provide a, let's say 10,000 rupees of future economic benefit every year. If it is a new machinery, it will give me a 10,000 rupees of cash flow, right? Cash inflow. You cannot say this. So you have to estimate cash flow in the current condition. You have to estimate cash flow in the current condition, right? It has to be in the current condition. Cash inflow should be from the continuing use of the asset. Okay. If you will use the asset continuously, if you're using the asset, for example, you are estimating the cash flow. Of course, the first one is current condition. Second, from use of the asset, what are the cash inflow which will come from using the asset, as well as you have to net off cash outflow also. For example, if you will use the machinery, there is some repair and maintenance expenses of that machinery as well, right? So you have to feed some grease, oil in that machinery. So there is some expenses. So you have to take both cash inflow as cash outflow from continuing use of the asset. Cash outflow which are necessarily incurred to generate the cash inflow from continuing use of the asset. If you would not have incurred the cash outflow, probably you would not have generate the cash inflow. So you have to take cash inflow as well as cash outflow from continuing use of the asset while doing the cash flow projection. Okay. Net cash flows, if any, to be received or paid for the disposal of asset. This is talking about the terminal cash. Terminal cash. So friends, if I'll summarize what is the inclusion in cash flow. First, it should be as per the current condition of the asset. Second, it will take cash inflow and outflow from the use of the asset and terminal cash flow at the end of the life of the asset. These are the cash inflows, right? What is not included? Future restructuring to which an entity is not yet committed. Entity is saying, after 5 years, I will do the future restructuring and I will have a cost savings in future. So that is why my cash flow will be higher after 5 years. Answer is no. If the future restructuring plans, which is only a plans and which is not yet committed, so those cash flows due to future restructuring is not to be taken into consideration, right? Improving or enhancing the asset performance. You cannot say that after 3 years my asset performance will enhance or it will improve. I will do some repair expenditure, it will improve, it will enhance, and so I need to take a cash flow, increased cash flow, improved cash flow after 3 years. Answer is no. You cannot take that. Cash inflow or outflow from financing activities and taxation activities. So you remember I have told you that cost to sell does not include finance cost and income taxes. Likewise cash flow due to financing activities and income tax. So financing activities, I mean to say finance cost and income tax. So cash flow due to these items will not be taken into consideration, right? So what is not taken into consideration? First of all, what is getting taken into consideration? So cash flow in the current condition of the asset, cash flow from use of the asset, and at the end of the life of the asset is to be taken into consideration. What is not going to be included? First, future restructuring for which an entity is not yet committed is not going to be taken into consideration. Improving or enhancing the asset performance is not going to be taken into consideration. Cash inflow or outflow from finance cost or financing activities as well as income tax is not going to be taken into consideration, right? I hope it is clear to everyone. Yeah, is it clear? Coming to the discount rate, sir, whether if I have to do the impairment testing for a building, so do I need to take the discount rate appropriate to the building, or do I need to take a discount rate for the entire entity? So first of all, students, discount rate should be taken for a particular asset, right? Discount rate should be taken for a particular asset. Sir, if the discount rate for particular asset is not there, when I say particular asset, if you are going to take a loan on that asset from a bank, then what will be the interest rate for that particular property? For example, the discount rate or interest rate for a property could be a lower than the interest rate for a car, right? If you want to take a vehicle loan, probably it will be 8%, but home loan can be taken at 6% or 6.5%, right? So it should be asset specific, sir. But if the asset specific discount rate, I mean to say interest rate, is not there, then standard says that then you can apply the weighted average cost of capital of the entity. If the WACC is there, for example, Bharti Infratel Limited is applying WACC, weighted average cost of capital, right? Or if the weighted average cost of capital is not there, you can apply entity's incremental borrowing rate. If the entity will take a loan, then at what interest rate this loan will be given by the bank to that entity? Incremental borrowing rate. If I have to take a loan for the value of this asset, what is the interest rate, okay, for that particular entity, right? So first you need to apply a weighted average cost of capital, then you need to apply an incremental borrowing rate, or if the incremental borrowing rate is also not available, then you have to go for some other market borrowing rates, right? Is it clear, guys? And this interest rate, this discount rate should be a pre-tax rate. For example, don't get confused. In the question, it will given that. In the question, it will be given that the interest rate is 10%, right? And whatever interest cost, the company will expense, the company will have a 30% tax benefit as an expense, right? So what is my pre-tax rate? My pre-tax rate is 10%. What is my post-tax rate? If I will spend interest cost, of course, it is a tax deductible expense and I will get a benefit of interest expenses, right? So friends, pre-tax rate is 10%, but post-tax rate is 7%. If you will have a 30% of tax benefit, it will be a 7%. So my dear friends, standard says that the discount rate should be a pre-tax discount rate and it should be asset specific discount rate. If the asset specific discount rate is not there, then you have to either go for the weighted average cost of capital or the borrowing rate applicable to the company. You can go for these two rates, right? Okay. Is it clear? Is it clear, friends? I hope it is clear to everyone. Yeah. Now let me see if there is any query. Mr. J is asking, sir, in revised depreciation, impairment amounts to change in accounting policy? Answer is no. This is not a change in accounting policy. This is event based, right? This is kind of an estimate. J is asking, will journal entry for transfer of impairment loss to PL to be passed? It is not required. If the question does not ask for journal entries, you are not required to pass those journal entries. I have just passed to make you guys more clear on this aspect. Jay is again asking, sir, whether cash flow needs to be considered for 5 years only. Yes, Jay, cash flow should be considered for a maximum period of 5 years until and unless the longer period is more justified. For example, in case of an airline industry, the life of the aircraft is 20 years or 25 years, right? If you will take a cash flow only for 5 years, I can tell you this aircraft will impair every year, right? Because if you are taking an asset for using that asset for a 20 years or 10 years or 15 years, probably there could be a situation where after 5 years or 10 years, you will have a break even. And after 10 years, you will start earning. Okay. So if the longer period is justified, for example, there is a technical evaluation that the life of this asset is 10 years, 20 years, 15 years. Of course, in that case, you have to take a projection for a longer years, right? Otherwise, if you don't have a proper logic for that, so in that case, you have to take a cash flow projection only for 5 years, right? Again, another question from Jay. Site restoration cost at terminal will be part of value in use. So Jay, in case of a terminal cash flow, if you are expecting some outflow in future at the time of end of the life of the asset, probably you can net that outflow with the cash inflow, right? Jay is asking again, major replacement in future which will increase performance will not be part of the cash flow. No, it will not be part of the cash flow. The major replacement, major overhauling, major inspection will not form part of your cash flow, right? So you have to take the cash flow according to the asset in the current condition, and you are not required to take the cash flow expecting that the performance will improve or performance will enhance. I hope it is clear to everyone, guys. So we have talked about the impairment loss, we have talked about the recoverable amount, fair value less cost to sell, value in use, right? Foreign currency cash flows, right? And we have done 3-4 case study today to understand these concepts. So guys, today I'll stop here. Today I'll conclude my session here, and the next session on impairment of assets will be on Sunday, right? At the same time, and I will complete this session in days 36 in that class. So on in days 36, 2 classes are allocated. One is today and one is on 10th, right? So on 10th, this session will be concluded. This in days 36 will be completed. So till the time, thank you so much. And I'll pause for 30 seconds. If you have any question, you can raise that question. And if today's concepts are clear to you, then I will be happy to conclude the session today at this point of time. Yeah. There is no question as of now. So thank you so much, student. Thank you so much, friends. Stay safe, stay happy, and stay healthy. So we'll meet on 10th. We'll meet on Sunday to complete this standard, to complete in days 36. Thank you so much. Bye bye. Take care.